pecho. No amarela que hice eso. Deja de quemarme el chaleco. Me pone la mira en el pecho. Y no sube esa mira del pecho. No amarela que hice eso. Deja de quemarme el chaleco. Eco. A Mandela, a Mandela, a Mandela, a Mandela.
Today we are exploring the fascinating history of the pound sterling, the official currency of the United Kingdom. First, we go to the introduction. Known as GBP, the pound sterling is the oldest currency still in circulation, with roots tracing back over 1,200 years. Its name comes from the Latin word illibra, meaning balance or weight. The Bank of England began issuing pound notes in 1694, while coins have been minted since 1489. The introduction of the decimal system in 1971 marked a significant change, simplifying the currency from shilling and pennies. In 1971, the pound was allowed to float freely, letting market forces determine its value. Despite the rise of the euro, the UK chose to retain the pound, reinforcing its unique identity.
The Brunei dollar, also as the Brunei ringgit, has been the official currency of Brunei since 1967. Before its introduction, Brunei used various forms of currency, including cowrie shells, bronze teapots for barter trade, and the Spanish-American silver dollar for international trade from the 16th to the 19th centuries. In the 19th century, Brunei issued tin coins called pitis and a 1 cent coin in 1888. As a British protectorate in the early 20th century, Brunei transitioned through the Straight dollar, Malayan dollar, and the Malayan and British Brunei dollar before adopting the Brunei dollar in 1967, following the formation of Malaysia and Singapore independence. The Brunei dollar pegged to the Singapore dollar at par under a currency interchangeability agreement is issued by the Central Bank of Brunei Darussalam and is subdivided into 100 cents. It circulates in denomination of 1, 5, 10, 50 and $100 in banknotes and coins ranging from 5 to 50 cents. While it is customary tender in Singapore, it is not legal tender there. The history of the Brunei dollar reflects the country's economic and political evolution from the barter trade to a modern currency system linked to the Singapore dollar.
Hi everyone, let's take a quick look at the history of the Canadian dollar and its evolution. In 1858, Canada issued its first coins, replacing the Canadian pound with the Canadian dollar. Later, in 1871, the federal government introduced the Uniform Currency Act, unifying the country's currencies under one national dollar. Over time, the Canadian dollar has alternated between being tied to the US dollar or gold and floating freely on the foreign exchange market. It first floated in 1950 but was pegged again from 1962 to 1970 under the Bretton Woods system. Since 1970, it has fluctuated freely alongside global currencies. The Bank of Canada managed banknote production and distribution. Canadian coins feature the British monarch on one side and unique designs on the other. The loonie, introduced in 1987, replaced the one bill in 1989, and the toonie, launched in 1996, replaced the $2 bill. In 2012, Canada stopped producing the penny, phasing it out entirely by 2013. Cash transactions are now rounded to the nearest 5 cents, while non-cash transactions remain exact. Today, Canadian banknotes are issued in 5, 10, 20, 50, and $100 denominations, while coins include 5 cents, 10 cents, 20 cents, 50 cents, $1 and $2. The Canadian dollar's journeys reflect the nation's growth and adaptability, remaining a vital part of Canada's identity.
New Zealand dollar (NZD) is the official currency in New Zealand, a country consisting of around 600 islands with a total area of 100,000 square miles. Originally, New Zealand used the New Zealand pound until 1967, when the currency was replaced by the NZ dollar for a more efficient and modern system. Although the idea for a decimal currency was proposed in 1930, it was not accepted until 1950. The NZ dollar is known as Kiwi dollar, referring to a kiwi bird feature on the $1 coin. In 1999, polymer banknotes were introduced and it improved their durability and security. Today, NZ dollar includes 5 banknotes, which is $5, $10, $20, $50, and $100.
Next, based on the variation of the percentage change of the currency graph, several factors influence the currency fluctuation, which are of an economic nature, such as inflation rate and political indicator. Let's start with inflation. In December 2024, the UK's yearly inflation rate fell to 2.5%, slightly below expectation. This decline was supported by lower prices in dining, accommodation, and entertainment. However, food price remained steady at 2%. In contrast, Malaysia saw its inflation rate decrease to 1.8 in November, driven by easing transport and health prices. Interestingly, food costs surged at their fastest pace in a year. This trend indicates different economic pressure. The UK inflation aligned with the Bank of England's goals, suggesting a stable economic outlook. Meanwhile, Malaysia easing inflation hint at lower demand pressure, which could influence monetary policy decisions in both countries. Shifting gear to political factors, the GBP experienced notable volatility in 2024, particularly around the UK general election. On May 22, Prime Minister Rishi Sunak announced election for July 4. While initial market reactions were mute, the potential for political change created uncertainty, impacting investor sentiment and causing fluctuation in the GBP. As the election approached, the pound rose to end one-year high against the dollar. Meanwhile, Malaysia enjoyed political stability under Prime Minister Anwar Ibrahim, attracting over $16 billion in foreign direct investment from major tech companies like Amazon and Google. This influx has strengthened the MYR against the GBP. Additionally, Malaysia's collaboration with Singapore to develop a new economic zone in Johor, focusing on AI and technology manufacturing, has further boosted investor confidence. In conclusion, the fluctuation of the GBP and MYR are deeply intertwined with economic indicators like inflation and political stability. As these factors evolve, they will continue to shape the currency landscape.
The line chart shows how the exchange rate changed from 1 January to 30 June 2024. The exchange rate for MYR per BND reached its highest point on 3 January at about 0.4052%. This means the Malaysian ringgit lost value compared to the Brunei dollar, requiring more MYR to buy 1 BND. The reason for this include factors like economic data and political stability. The exchange rate movement between the Brunei dollar and Malaysian ringgit during this time was mainly affected by inflation rate. In January, February, and March, Malaysia inflation rate rose from 1.5% to 1.8%, while Brunei experienced deflation, with inflation dropping from 0.1% to negative 0.1%. The higher inflation in Malaysia and deflation in Brunei caused a gap that strengthened the BND and weakened the MYR. These inflation differences explain the peaks in the exchange rate. Political stability in Malaysia also played a big role. In early 2024, events like the announcement of a partial pardon for former Prime Minister Najib Razak and the Federal Court's decision on Kelantan Islamic law caused political uncertainty. This likely will worry investors and lead to the money leaving the Malaysia, making the MRR weaker. For example, on 19 February 2024, the exchange rate increased by 0.2959%, showing a sharp drop in the value of the MRR. However, after this date, the MRR began to recover with the exchange rate improving steadily. On 23 February, the rate fell by -0.2302%, meaning the MRR strengthened and took fewer MRR to buy 1 BND. This recovery showed growing confidence in Malaysia economy and political situation.
Now, let's explore how economic and political factors influence the fluctuation of two currencies, the Malaysian ringgit and the Canadian dollar. In Malaysia, the unemployment rate remains steady at 3.3% from January to June 2024, returning to pre-pandemic levels. The number of unemployed declined year over year by up to 4.8%, reaching a 4-year low of 565,300 in June. Employment steadily grew, hitting a record 16.61 million in June, with the labour force participation rate rising to 70.4%. This trend reflects Malaysia's robust labour market recovery. In contrast, Canada's unemployment rate increased from 5.7% in January to 6.4% in June 2024, the highest since January 2022. This rise, driven by higher interest rates, saw unemployment grow from 1.243 million to 1.4 million, particularly affecting young people and men in their prime working years. While wage growth peaked at 5.2% in May and June, net employment fluctuated, highlighting challenges in Canada's labour market amidst restrictive monetary policies. Next, in Malaysia, Deputy Prime Minister Fadilah Yusof expressed optimism for 2024, projecting economic growth of 4 to 5%. The government has avoided recession and managed inflation, focusing on infrastructure, green initiative and industrial growth. Investment worth 2 to 5 billion have created 19,000 jobs, while Malaysia remains committed to becoming carbon neutral by 2050 through projects like the Sarawak Environment Bill and the National Energy Transition Roadmap. Meanwhile, in Canada, geopolitical action focused on human rights. In response to abuses in Xinjiang, Canada has implemented measures like banning imports tied to forced labour, offering business guidance and enforcing export control. These steps aim to protect human rights and ensure responsible business practices among Canadian companies. So the economic and political factors play a significant role in shaping currency fluctuation, while Malaysia shows economic resilience. Canada grapples with labour market challenges and geopolitical commitment, each impacting their respective currencies.
The graph shows the percentage changes in various currencies, including the New Zealand dollar over time. The NZD fluctuation in 2024 were mainly influenced by economic indicators and political issues. Now, I will explain both issues that relate to this matter. We will look at the economic indicator first. In 2024, New Zealand economy showed mixed results with 2 consecutive quarters of recession. The GDP grew by 0.2% in March quarter but shrank to 0.2 in the June quarter. A rise in GDP suggests economic which can attract foreign investment and increase the demand for NZ dollar. It also led to its appreciation. Conversely, a decline in GDP signal slower the economic growth, and it will make the NZD less attractive to investors and it will cause to depreciation. Next, New Zealand inflation rate fluctuated in 2024. Inflation was expected to rise in early 2024, but it fell below the 3% in the second half of the year. Lower inflation may lead to reduced interest rate, boosting consumer purchasing power, and also can support the economic growth. However, the lower inflation can also weaken the NZ dollar due to currency depreciation. On the other hand, high inflation often prompts the central bank to raise the interest rate, and it also can strengthen the NZ dollar. This creates opportunities for a global economy as a weaker NZ dollar reduces the export cost, which making New Zealand goods and service more competitive in global market. Next, we will look at the social and political issue. In November 2024, 42,000 protesters marched near Parliament to oppose a law seen as undermining the Treaty of Waitangi and restricting the Maori right. Such protests and rising racial tension may create an investor concern about the country's social stability. Large-scale protests signal a social unrest, which can lead to uncertainty about policy direction and discourage the foreign investment. Investors prefer stable environment with predictable policy, so instability may push them towards safer investment. As a result, capital may leave New Zealand and it will decrease the demand for the NZD and causing its value to depreciate. So all this matter is the reason why the currency of NZD is always fluctuated according to the year 2024.
Let's talk about why the MRR per BNB currency pair is ranked number 1. The main reason is Brunei political stability and solid governance, which build a lot of investor confidence. Brunei is an absolute monarchy with Sultan Hassanal Bolkiah holding significant power not only as the ruler but also in key government roles. This ensures that corruption remains low and public satisfaction is high, especially thanks to generous welfare program funded by the country origin. Now, because of this stability, Brunei has stayed peaceful and under control even with the emergency law that been in place since 1962. There has been no major political violence recently, and this calm rule has led the Brunei dollar to rise a little against the Malaysian ringgit. On the flip side, Malaysia has some political challenges that create uncertainty. For example, the partial pardon for former Prime Minister Najib Razak and some legal decisions in early 2024 have stirred things up. This type of instability often leads to capital leaving the country, which weaken the overall Brunei political stability, make the MRR PBNB pair a reliable, low-risk investment with consistent return, securing its position as a top-ranked currency pair.
Last but not least, the MRR GBP currency pair, which currently hold the second spot among selected currencies. Let's start with the UK. Recently, the inflation rate here has dropped to 2.5%, aligning with the Bank of England target. This indicates a stabilizing economy, reducing the possibility of drastic monetary policy shift. But keep in mind, political uncertainty looms with the 2024 general election approaching, which can cause fluctuation in the GBP. Now, turning to Malaysia, the MRR is bolstered by strong political stability and a notable rise in foreign direct investment. These factors have contributed the MRR strength, partly offsetting any gains for the GBP. Together, these influences have helped maintain the MRR position against the GBP, keeping it in the second position among currency pair. We see slight improvement with minimal risk due to consistent economic indicators from both countries.
Okay, now let's take a closer look at the recent performance of the Canadian dollar and Malaysian ringgit exchange rate. During the observation period, the CAD per MYR value declined slightly by negative 0.0038%, reflecting the influence of political and economic factors on both currencies. In Canada, restrictive monetary policies have contributed to rising unemployment, particularly among young men in their prime working years. This has dampened investor and consumer confidence in the CAD as the economy struggles to meet expectations. Additionally, Canada's historically significant but strained trading relationship with China has added uncertainty, while Canada's effort to diversify trade partnership offer long-term potential. They have introduced short-term volatility for the CAD. Despite these challenges, the CAD per MYR exchange rate has shown reasonable stability, ranking third among currency pairing in terms of profitability and stability. However, external factors like trade relations and unemployment continue to limit investment opportunities with moderate to high volatility. In summary, the CAD or MYR rate reflects a delicate balance of economic pressures and evolving trade dynamics.
The NZ dollar is ranked to the lowest compared to other currency due to various factors that I have explained before. It experienced a negative return on the average foreign exchange rate. This depreciation is driven by the economic indicator, political issues, and also the changes in the government policies, such as interest rate reduction, which each can lead to the increase on the currency volatility. Next, the depreciation of NZD impact business differently. Importers face higher costs for goods from the other countries, which it can increase their expenses. In contrast, the exporter benefit the weaker NZD, which make their product cheaper in global market. When the product is cheaper, it can boost the demand and revenue. Despite its challenges, the NZ dollar offer moderate profitability with gain of exporter balancing.
Assalamualaikum. My name is Muhammad Shahid Zaim, and today I'm going to present on the profit and loss assessment. For forward contract, we have chosen the currency of GBP against Ringgit Malaysia at the lowest exchange rate peaks for 2 months, which are April and June. For April, the lowest exchange rate peak on 23rd of April, where the bid rate is 5.8916 and ask rate is 5.9372. For June, the lowest exchange rate peaks on 27th of June, where the bid rate is 5.9525 and ask rate is 5.9650. Using this rate as spot rate, we calculated the cross rate and forward rate. For the cross rate calculation, the first quotation is GBP against Ringgit Malaysia, and the second quotation is New Zealand dollar against Ringgit Malaysia. Ringgit Malaysia is the home currency, while GBP and New Zealand dollar are both foreign currency. The first cross rate is GBP per New Zealand dollar, where GBP is the home currency and New Zealand dollar is the foreign currency. To find the bid rate for the cross rate, we use spot bid of foreign currency and divide it with ask rate of home currency. For ask rate of cross rate, we use spot ask rate of foreign currency and divide it with spot bid rate of home currency. From the cross rate, I can conclude that a stronger cross rate of one currency compared to the other indicates that each country may possess better economic fundamentals such as higher interest rate, strong GDP growth, or a trade surplus, making its currency more appealing to investors. On the other hand, a weaker cross rate might suggest poor economic performance or macroeconomic challenges like high inflation, political instability, or dependence on external borrowing. Moving into forward rate calculation, we assume that the 1 month interest rate for Malaysia is 3.5%, while UK is 4.5%. For 3 months interest rate for Malaysia, it is 4%, while UK is on 5.5%. From the calculation, we presume that a forward premium, which occurs when the forward rate exceeds the spot rate, indicates that the market expects the base currency, in this case GBP, to strengthen against the quote currency, which is Ringgit Malaysia. On the other hand, a forward discount where the forward rate is lower than spot rate suggests that the base currency is expected to weaken. Moving on to the next, which is future contract. We have the mark-to-market calculation from 30th May until 17th May. We open our position on the 30th May in the morning. Based on the exchange rate during that duration, we decided to take long position even though the price fluctuated in both directions. The move upwards was more significant compared to the moves downwards, making long positions more favorable. The formula used to identify the profit is P1 minus PO times number of contract times number of position. On the closing day, we managed to make a profit of 1,250 ringgit. Lastly, we are required to do an option contract analysis. A call option gives the buyer the right to buy the underlying asset at the strike price, making it beneficial when the asset's price rises above the strike price. Investors typically purchase call options when they expect the asset's price to increase. On the other hand, A put option gives the buyer the right to sell the underlying asset at the strike price, which is advantageous if the asset's price falls below the strike price. Investors use put options when they anticipate price decline, either to profit or to hedge against potential losses in their portfolio. Investors are advised to use call options for bullish market expectations, while put options for bearish market scenarios. For the conclusion, the analysis reveals that the Ringgit Malaysia was stable against Brunei dollar, offering low risk and moderate profitability, while it faced moderate volatility against the GBP due to UK inflation and political uncertainties. The Ringgit Malaysia against Canadian dollar and Ringgit Malaysia against New Zealand dollar pairs experienced higher volatility, influenced by Canada's restrictive policies and New Zealand's economic recession, respectively benefiting exporters but challenging importers. Profit and loss assessment emphasize the importance of tools like forward contracts for managing risk and capitalizing on favorable rates. Investors should prioritize stable pairs like Malaysia Ringgit per Brunei dollar for lower risk opportunities and use hedging strategies for more volatile pairs while monitoring economic and political trends to optimize returns. Thank you.